So I was recently doing an account update and I happened to talk about ARK Invest a little bit, and I noticed that Roku is actually a really large portion of Cathy Wood's ETF. So I decided to do a little shallow dive about it. So I wanted to look into company real quick to just figure out its numbers and do my famous, yes, it's coming back. It's coming back. Wait for it. Yes, the kitty rating. It's here. It's a very professional, very refined, and scientific rating system on each one of the elements required for an investable company. So I'm going to go through all of them and we'll see how Roku scores on the kitty rating system. So for that, I'm going to be using stockanalysis.com just to get all the numbers. It's a really cool site that I like to use. Definitely not affiliated with them, not affiliated with anyone or anything. First thing I like to do is just to do a little brief overview of the yearly numbers down here in this little box. And it looks like they made some money in 2021. That's fine. But as we find out in a little bit, we need to look at things in detail in order to unearth the truth about each company. Now, it looks like they round tripped just like the rest of ARK back to about the price that the stock was 5 years ago. So basically round tripped. It's a little bit higher than that now, maybe at the level it was in December of 2017. First thing we're going to do, if we're going to use this kitty system, is we're going to look at the revenue. Revenue is actually important for stocks like these. This is a growth company, so they really care about the revenues. Everybody looks at the revenue for growth companies. They want to look at revenue acceleration. So this is a metric that's actually pretty relevant to this company. So let's take a look at the most relevant metric on this company. We don't want to just look at annual because annual looks like an exponential graph, but I like to look at the quarterly because that gives us a little bit more definition, right? Definition. We don't want pixelated information. We want it as least pixelated as possible. And it looks like the revenue has actually been topping off over the last year. So that's not super encouraging news, especially for a growth company like this that doesn't make any money. If we go to the kitty system, that's a necessary board kitty. And in fact, someone mentioned that I should be doing multiple ratings for each kitty if I think it's a very relevant statistic. And I think this is or for whatever reason I want. I think this is a very relevant statistic. It's the most relevant. And if it's boring, that doesn't say a lot for the company. I'm going to have to give it 3 board kitty points because this is a really big hit right off the bat. The next thing I want to look at is earnings trend. Now, if we look at the earnings, as I mentioned, this is a growth company, and so the earnings are absolutely abysmal. It looks like they made money in the 2020s when everybody was at home watching Roku. But ever since then, in the last 2021, whether they're doing reinvestment or whether their business is just falling off the train rails, it is relevant, but the fact is this company has no earnings. In fact, it's losing $120 million per quarter, considering their revenue is $700 million a year. So these are huge bleeds, huge losses. I know part of the reason why might be because they're investing in a TV set that they've been manufacturing. And that's all fine, dandy, and grand. I think that's actually a brilliant idea. But I'll talk about that why when we get to the story portion of the company. For now, I'm going to have to give to earnings trend an actual sourpuss. It's pretty significantly bad. So I don't know if that money is ever going to get recouped. And I don't know if that I don't know if that company deserves its $7 billion tag. I mean, it's a lot of risk to be taken for that much money. So even still. So that's just a preliminary rating here. Preliminary conclusion. Dividend payout ratio, obviously, it's a sourpuss because it doesn't have any dividends. It's a growth company. Share buyback trend. Okay, I haven't looked at this yet. Let's take a look at the shares outstanding diluted. Okay, so they've been selling shares, which is expected for a growth company like this. into the open market, but not much. It looks like mostly they're financing their ventures through debt, only a little bit through share selling. So that's not bad. I mean, obviously not a positive, but it's definitely a board kitty rating. It just, just 1 point. What's next here? Cash on hand. All right, this company, let's see what this looks. I haven't actually looked at this yet. I'm looking at it for the first time with you. We're going to go to the balance sheet and we'll see that net cash, okay, total debt, 650 million. So this is not bad. Net cash, 1.37 billion. That's actually really good. They've stacked up some money. So let's see. Another way you can tell about how much net cash has is if you subtract, the enterprise value from the market cap. So right there, you could tell that it's $1.3 billion. If I would have looked at that first, I would have known that. So that's actually positive news because they can, if they do actually go in debt, I don't know how they raise that cash, maybe through selling shares through the boom days, or left over from private investment. I don't know. I doubt it's from the earnings that they had during 2020. I don't think they earned that much money. So, but anyways, that's a lot of cash. So they can last for quite some time. Actually, I think that's a really positive rating for this company. I'm going to have to give it 2 approval cap points here on the cash on hand. That's quite a bit. If they're losing 122 per quarter, they can last for quite a few years before they earn any money and have to tap the investors for more by selling shares in the open market, or tap the bankers and go into debt in order to continue to fund their operations. So this is actually really encouraging. I mean, I didn't expect this at all. I'm going to have to give it another. I'm going to go for 3 approval cats here. This is really good cash management. And I didn't figure this in. Okay, next on the chopping block is the price to earnings ratio, which is, of course, non-existent. We don't need to look at that. That's obviously a sourpuss. Oops. That's 3 points now. A sourpuss rating. Next on the chopping block here, price earnings. Okay, enterprise value over earnings. That's also in the negatives, right? Or NA. Sourpuss. Okay, enterprise value, free cash flow. They have no free cash flow. So where is it? EV over FCF. It's NA. Yeah, so NA. Okay, well, a lot of negatives just because it's a growth company. It doesn't mean it's uninvestable, though, right? All these, it just means that it just doesn't fall into that bracket. Okay, what do we got? Profit margin trend. So these are 2 categories. So I have to look at them both. Profit margin, we can tell right here. And this is yearly. Hold on, let me go quarterly. Okay. Gross margin, profit margin. All right, so obviously it was doing good in the 2020s. The margins, were expanding, but then it contracted big time, and now they're in a negative. It's a negative 16.05, and the trend is not looking good either. I'm gonna have to do a negative for each one of those, scoring us a total of 7 sourpuss rating points so far, which is quite a bit. And then finally, the story, like I mentioned earlier, I looked at the news items and stuff real quickly, and they're doing something that I actually applaud, which is they're building their entire TV set. I have no idea why more companies haven't thought of this yet, especially like companies like Netflix, Apple, Paramount, all these companies. Why don't they have a hardware piece? Don't they know? Like, haven't they seen Apple? Right? You get the hardware piece, you make that nice, cool, sleek, and attractive, and then you build the software on top of it. There are good examples of companies trying to do it backwards and having a moderate success. The most notable example that I can think of is Amazon. Amazon built out the Kindle, right? That was a big success. Kindle Fire was okay, whatever. I think Kindle's better because of the readability, right? But they built a hardware piece for, and now they're basically the monopoly book business in the entire world. I mean, if you don't go through Amazon, what are you doing? If you're a bookmaker, I have some books on Amazon. I have like 3 tennis books. I used to be a tennis pro, or still am, like part-time. And I have books on tennis, and they're doing great on Amazon. I posted a book on some other platforms other than Amazon. I got 0 sales, completely 0. So Amazon is a good example of this. Google tried and is still trying with the Pixel. They're trying to, but phones are a little bit tough because you have to compete with Apple. But other devices, right, you don't have to compete as much. TVs is brilliant because, who else is making TVs that's a big name? Another good example of this is Tesla, actually. Many of you don't realize, but there's a screen inside of the cars, right? The whole infotainment system. So Tesla owns that screen. So they have a screen hardware too. So if you can get some kind of a monopoly on a screen and then have your software on top of it. I mean, if you're watching TV on Roku TV, then you're going to be using Roku software. I mean, I can't imagine somebody buying a Roku TV and using like Apple TV or something like that for software. So anyways, actually, I think Apple might be developing a TV. I'm not exactly certain. If you know about that, put it down in the comments. But I think that's a brilliant strategy. Like, I really don't know why people haven't done that yet. And, there are other screens. The watch is a very small screen, but Apple owns that at the moment. There could be another company that makes a better watch, but you still have to compete with Apple Watch, which is tough, I realize. But still, anyway, you got my point. Like, Roku's trying to take over the one screen, the biggest screen that people haven't really tapped into yet, which is absolutely astonishing to me. So I'm going to have to give him big props on the story, just because of that. And also, I mean, they are focusing on expanding, on growing, all that. They're adding more, subscribers, users, whatever, accounts. So that's still happening, although at a very slowing rate, which is concerning. So the story is a little bit of a mixed bag, but because of their idea to develop TV, I'm going to have to give them like 3 extra points. I'm going to have to put them at 6. So this is the overall picture for Roku, guys. We got 6 approval cats, 4 bored kitties, and 7 Star Plus rating because it's not a value company. Overall, the valuation of $7 billion doesn't look too bad at this point. I mean, it's actually 5.71 if you take out the cash. And because they have cash, they can survive for quite a bit longer. I started off pretty negative on this company, but now I'm actually a little bit constructive after doing the shallow dive. Of course, this is just a shallow dive. You can't make I'm not making any kind of recommendations to buy or sell the company. You guys got to do your own due diligence, your own research, and dig further into the company to try to find out what exactly it's doing. I mean, if you haven't read its last like 3 or 4 or 5 filings, you're not ready to invest into a company. Like, that's just pure fact. I mean, you're just kind of guessing, speculating, and just riding a trend. Whether you make money or not, that's fine, but it's not a real investment, right? So make sure you do a lot more digging into the company than I just did, because I literally just spent 20 minutes on this, right? It's just the beginning. So you got to do the rest of the work. So make sure that you do your research and let me know what you think about the company, whether you own it or not, and what are your thoughts about its future. And also, I'm really interested into knowing, why do you think Cathy is investing so heavily into this company? It boggles my mind. Peace out.